Hello and welcome back to FX Limit, your go-to channel for all things related to Forex trading and technical analysis. Today, we're diving into a topic that has been highly requested by many of you, understanding how to use momentum indicators to assess the strength of a trend. Specifically, we'll be focusing on two popular indicators, the Average Directional Index, or ADX, and the Moving Average Convergence Divergence, known as MACD. Let's start with the ADX. This indicator is all about trend strength. It doesn't tell you the direction of the trend, but rather how strong it is. The ADX is part of the directional movement system developed by J. Wells Wilder and is composed of three lines, the ADX line itself, plus two directional movement lines. The key here is the ADX line, which will help us understand the strength of the current trend. A rising ADX line suggests an increasing trend strength, whether bullish or bearish. Generally, an ADX value above 25 indicates a strong trend, while a value below 20 suggests a weak or non-existent trend. But how do you use this in trading? Well, if you see the ADX rising above 25, it might be a good time to enter a trade in the direction of the prevailing trend. However, if the ADX is declining, it could be a signal that the trend is weakening, and you might want to think about exiting your position. Now, let's talk about the MACD. This is a more complex indicator because it shows both trend and momentum. The MACD consists of two lines. The MACD line, which is the difference between two moving averages, and a signal line, which is the average of the MACD line. There's also a histogram, which represents the difference between the MACD line and the signal line. The MACD is great for identifying trend reversals. For instance, when the MACD line crosses above the signal line, it's considered bullish, and when it crosses below, it's bearish. The histogram also adds value here. When it's positive, the MACD line is above the signal line, and when it's negative, the MACD line is below the signal line. So, how can you use the MACD in your trading strategy? A common approach is to look for crossovers. When the MACD line crosses above the signal line, it could be a good time to buy, and when it crosses below, it might be a time to sell. Additionally, pay attention to divergence. If the price is making new highs but the MACD isn't, it could be a sign of a weakening trend. In summary, both the ADX and MACD are powerful tools in a trader's arsenal. The ADX helps you gauge the strength of a trend, while the MACD gives insights into both trend direction and momentum. Remember, these indicators are most effective when used in conjunction with other analysis tools and in the context of an overall trading strategy. And that's it for today's episode on FX Limit. I hope you found this deep dive into the ADX and MACD insightful and helpful for your trading journey. Don't forget to like, share, and subscribe for more content on Forex trading and technical analysis. We love hearing from you, so drop your questions or topics you'd like us to cover in the comments below. Until next time, keep analyzing those charts, and happy trading.